Ceiling negotiations have been deadlocked for more than 4 months, without any sign of progress. The U.S. Congress insists on implementing spending cuts to raise the debt ceiling, while the White House demands an unconditional increase. On May 23rd, Treasury Secretary Janet Yellen issued another warning, stating that if Congress does not raise or suspend the debt limit by June 1st, the U.S. Treasury will be unable to meet its debt obligations, potentially leading to an economic and financial disaster. This is not the first time Yellen has issued such a warning since the expiration of the debt ceiling in January. She explicitly mentioned that the U.S. may default on its maturing Treasury bonds within a week, placing the responsibility for the default squarely on the U.S. Congress. Although the U.S. Treasury and the Federal Reserve have been continuously monetizing U.S. debt, making the nation the largest debtor in the world, they attribute all debt and default responsibility to Congress. At this critical juncture, the focus should be on timely repayment of globally held Treasury bonds rather than engaging in discussions about responsibility. If the U.S. defaults on its debt on June 1st, several consequences are expected. Firstly, analysts predict that the U.S. Treasury's cash reserves will be depleted by that date, as it is projected to receive $26 billion in revenue, but will be unable to pay $101 billion in debt obligations. Additionally, $47 billion earmarked for the elderly public health care program will go unpaid, and U.S. soldiers may face the prospect of unpaid salaries. Even if the U.S. manages to meet its debt obligations in a timely manner, the stock market may still face turmoil. Retirees and Social Security beneficiaries will be deprived of $25 billion that is rightfully theirs, while states will be unable to access $2 billion in funds for medical assistance and insurance subsidies for the impoverished population. Public agencies in many regions will struggle to pay salaries, and manufacturers supplying weapons to the U.S. military and other companies will face at least $2 billion in outstanding payments if defaults persist beyond June 6th. If the debt crisis continues, federal commitments will become empty promises after June 7th. The Treasury, which was supposed to collect approximately $110 billion in tax revenues, will be unable to pay its bills due on June 1st. As more bills come due, tax refunds are expected to be delayed, resulting in at least $1 billion in arrears for U.S. citizens. On June 8th, education programs operated by some states and local governments will lose $1 billion in budgetary funds. With federal insurance payments halted, U.S. hospitals will face a crisis, leading to a collapse of the public healthcare system. By June 15th, the Treasury will need to pay approximately $2 billion in interest on U.S. bonds to global investors, presenting an even more challenging situation. While the Treasury has previously indicated the technical ability to prioritize interest payments over other expenditures, these revenues would be insufficient to cover other bills due on June 15th, such as military salaries. Yellen's latest warning on May 23rd suggests that the Treasury does not appear committed to timely debt repayment. The aforementioned potential economic disasters up until June 15th reflect the possible outcomes if the U.S. plunges into a debt crisis. Moreover, due to the Federal Reserve's ongoing interest rate hikes as of the end of April, the annual expenses required to service the massive U.S. debt have exceeded the 2022 defense spending. The U.S. economy cannot escape its debt predicament, even if the debt ceiling is ultimately raised. The current debt ceiling dispute has failed to serve as a warning and has instead exacerbated the U.S.'s reliance on debt. For example, the Treasury has hinted at the possibility of issuing 100-year U.S. Treasury bonds multiple times in the past 3 years. This highlights the ongoing trend of the Treasury Secretary Yellen, consistently attributing the risk of a potential debt crisis to the U.S. Congress, without addressing the underlying causes of excessive debt accumulation, overconsumption, and the ease with which global wealth is obtained through the U.S. dollar and Treasury bonds. In reality, the U.S. economy has long relied on the advantage of the dollar as a reserve currency and has indulged in excessive borrowing and consumption, which top bankers seem to take for granted. However, The repercussions of such actions are becoming evident as the U.S. economy faces a series of debt crisis risks and continues to burden the world with its Treasury bonds and the U.S. dollar, while attempting to exploit global wealth differentials through the Federal Reserve and various currency cycles. The trend of resisting dollar hegemony has become irreversible, as demonstrated by recent developments. Former Federal Reserve official Zoltan Pozsar pointed out on May 23 that certain changes should be closely monitored, as they could lead to a sharp decline in the U.S. dollar's role in commodity financing, trade financing, and reserve asset allocation. This reiterates the warning Pozsar issued not long ago regarding the decline of the petrodollar and the rise of the petro-yuan in global commodity trading, highlighting the potential severe damage to the U.S. dollar's position. If the U.S. dollar's position cannot be maintained, it would mean the termination of the profit logic that has sustained the U.S. economy for over half a century. The global trend of de-dollarization is evolving from a dollar crisis to a refusal to acknowledge debt. The continuous exploitation of the U.S. dollar as a weapon and the monetization of U.S. debt have led to a 26% increase in the global yuan index in 2022, posing a disaster for the debt-ridden U.S. economy. Countries worldwide are taking steps towards de-dollarization. Bolivian President Luis Arce recently stated that the Central Bank of Bolivia will explore the feasibility of using the yuan in trade with China. Bolivia has joined the ranks of 113 countries that have initiated formal steps towards de-dollarization, following the footsteps of countries such as Iran, Brazil, France, Saudi Arabia, Argentina, Iraq, and Vietnam. These countries are seeking economic and trade cooperation with the yuan as an alternative to the U.S. dollar. Renowned investor Jim Rogers has repeatedly warned that no currency in the world has a history exceeding 115 years, and the U.S., as the largest debtor nation, is burdened with debt everywhere. The current debt storm is exacting a heavy toll on the U.S., and it may trigger an unprecedented financial and debt crisis. With the acceleration of global de-dollarization, the era of the U.S. dollar is coming to an end, and American dominance is approaching its culmination. On the other hand, Rogers believes that the yuan has the potential to replace the U.S. dollar. The continuous exploitation of the U.S. dollar as a weapon and the monetization of debt have pushed the U.S. economy into a precarious position. The consequences of these actions are becoming increasingly apparent as global dynamics shift towards alternative currencies and a refusal to rely on the U.S. dollar. The U.S. economy must address its debt predicament and seek sustainable economic policies to adapt to this changing global landscape. Thanks for watching. I hope you enjoy the video and analytics from me. Like and subscribe, PLS.